First tonight, much of the analysis as to why the retail sector is finding it so tough right now pins the blame on assorted bogeymen, online shopping, interest rate rises, the strong Aussie dollar and so on. Today came a big picture explanation from the man whose actions are widely blamed. In a speech entitled The Cautious Consumer, Reserve Bank Governor Glenn Stevens effectively called time on the debt-fuelled consumption of the past, driven by cheap credit and soaring asset values, namely houses, that created a feeling of wealth. Here's Philip Lasker.
Like most Australians, Reserve Bank Governor Glenn Stevens isn't enjoying the debt dramas playing out in Europe and the United States.
Allowing things to go right to the brink of an extremely disruptive event before an agreement is reached on how to move forward has been a source of great uncertainty and anxiety right around the world. And that anxiety has extended to Australia.
And I think he's also concerned about just how smoothly, as he said, the liabilities can be shifted from the private sector to the public sector and collectively the public sector across the euro area. And that raises real concerns that governments in the creditor countries, particularly Germany, will not have the political wherewithal to be able to carry this with their own voters.
The Governor noted consumer caution had intensified over the past few months. Perhaps that's why the cautious consumer was the RBA's focus today.
Rather than people sort of assuming that they just don't understand what's happening to the weaker parts of the economy, I think they understand that very deeply, and then they'll make decisions about interest rates.
A decade of low inflation and interest rates starting in the mid-90s, according to the Governor, encouraged growth in lending, borrowing and spending as asset prices kept rising and household savings kept falling.
I was not among those who felt that this trend was bound to end in tears. But it was bound to end at some point.
Now, he says, consumers are adjusting to a new equilibrium of lower debt levels and saving at a surprisingly fast pace after seeing the global financial crisis destroy their wealth.
Sold to you, sir.
It seems pretty clear, to this particular armchair economist anyway, that changes in consumption behaviour and changes in the saving and spending and borrowing behaviour of households have been connected.
He avoided the politically charged talk of the rising cost of living, but suggested the fundamental changes were taking place despite the confidence-sapping natural disasters, talk of higher interest rates and the debt crisis.
It's entirely possible, it seems to me, that were some of the current raft of uncertainties to lift at some point, the mood could change quite noticeably, in fact. So I don't think we should be totally gloomy about the prospects for the consumer.
But the uncertainties are no closer to lifting as the political standoff to lift America's debt ceiling by August the 2nd continues. Analysts here say a default could be serious, but the US enjoys a privileged place.
The bottom line is, of course, that for governments around the world running foreign reserve surpluses, there really isn't a commensurate bond market to the US for them to invest in. So they need the US in relation to the management of their surpluses in external markets.
But governments around the world are hoping the US pays its bills.